University of Buckingham, Money, Banking and Financial Markets, Summer Term 2020, Lecture 6, Financial Instruments. Before we go into the lecture, just again, a reminder that the student experience is still here for you, despite the online teaching, and information about the Students' Union, Career Services, Students First and Student Conduct. This week we're going to actually look at a number of financial instruments, derivatives, mortgage-backed securities and credit default swaps. There are many financial instruments, but these are particularly interesting given the financial crisis of 2007 to 2008. Well, let's look first at derivatives. What are derivatives? Well, derivative securities derive their economic value from the underlying assets on which they're based. And how do they compare with forward transactions? Well, in spot markets, settlement is immediate, and for forward transactions, settlement is in the future. Although forward transactions provide some risk sharing, they have liquidity and information problems. Futures. A futures contract specifies delivery of a commodity or an asset or a currency at a future date at a current price. The buyer assumes the long position. The seller of the futures assumes the short position. Futures prices are set in the futures market, and the spot price is the price of the asset on the day of delivery. Futures contracts can obviously reduce risk through hedging by guaranteeing a price now rather than having to wonder what the price will be of the asset in the future. Examples of futures markets, well, interest rates, there's on treasury bills, on notes, on bonds, on municipal bonds, on Eurodollars, futures markets on stock indices, on shares themselves, stocks themselves, on currencies, and of course on commodities. Let's give an example of how a futures market works. Let's say we have a wheat farmer and a baker. In every futures contract, everything is specified. The quantity and the quality of the commodity, the specific price per unit, and the date and the method of delivery. Let's say both the wheat farmer and the baker are unsure about the fluctuations in price 1 year into the future of wheat. The farmer wants to sell 100 bushels of wheat, and the baker wants to buy 100 bushels of wheat. If they're uncertain about the price, they could agree to trade a futures contract in which the farmer agrees to sell to the baker the 300 bushels at $4 per bushel. In this case, the farmer takes the short position and the baker takes the long position. Both have a certain amount of money called their margin at the trading exchange. If the price goes up to $5, that means that the farmer has notionally lost $5. His account is debited $100, $5 minus 4 multiplied by 100, while the bread maker is credited $100. This will happen every day in the futures market. How it ends? After 1 year, if the price remains at $5, the farmer can sell his wheat at $5, so he gets $500. While the baker can use this $100 that he's got from the futures contract to buy wheat from a wheat market. The derivatives market need not involve the actual transfer of commodities, so it's not necessarily only for people who want to buy wheat or sell wheat, but also for people who want to bet on what the future price of wheat might be. What are the purposes of futures markets? Well, price discovery. Due to its highly competitive nature, the futures market has become an important economic tool to determine prices based on today's and tomorrow's estimated amount of supply and demand. So they're a way of actually seeing what will happen about expectations. So futures market prices depend upon a continuous flow of information from around the world, and thus require a high amount of transparency, and are close to an efficient market. Risk reduction. Futures markets are also a place for people to reduce risk when making purchases, particularly of commodities. Risks are reduced because the price is preset, therefore letting participants know how much they will need to buy or sell. The two types of players in futures markets are first hedgers, those who are buying and selling a future to correct against fluctuations in the price, and they will probably take a position and leave it until close to the price itself. And speculators, those who are buying and selling a future to correct against fluctuations in the price. So here are the two different types, the hedger and the speculator, and long and short positions. The hedger is, if they're taking a long position, they're securing a price now to protect against future price and prices. If they're taking a short position, they're securing a price now to protect against future declining prices. The speculator, if they take a long position, they're securing a price now in anticipation of rising prices. If they're taking a short position, it's securing the price now in anticipation of declining prices. Leveraging. Because you only have to put down the margin to trade in futures markets rather than the full price, the futures market is highly leveraged. Leverage refers to having control over large cash amounts of commodities with comparatively smaller levels of capital initially. Due to leverage, if the price of futures contracts moves slightly, then the profits you can make could be huge. Of course, the losses can also be large as well. Example. You buy a 3-month futures contract for 100 stocks for a company which is trading for $100. You put a margin down of $10,000, which is a lot less if you actually had to buy the 100 stocks. If the price rises to $105 in the next 3 months, you make a $5,000 on an initial investment of £10,000 or a profit of 50%. Without the margin possibility for the futures contract, you would have had to buy 100,000 of the share outright, and you would have made 5,000 divided by 100,000, which is only 5%. Plus, your capital is tied up for the 3-month period. Options. What are options? Option is the right to buy or sell an asset. Could be a share, could be a bond, could be a commodity at a predetermined price by a predetermined time. A call option gives the right to buy an asset. A put option gives the right to sell an asset. The strike price is the price at which the asset is bought or sold, and the option premium is the fee for paying for the option. You actually pay for the option itself. Example of how an option might work. You want to buy a house, you're unsure about it, you ask the landlord if you could buy it at his price, $100,000, but you need to think for a week. The landlord says he'll keep it for you at that price for a week, but will charge you a non-refundable deposit of $1,000. This is very much how an option works. You effectively bought a call option for a 100,000 asset for a £1,000 option premium. It's given you the right to actually buy the 100,000, the price of 100,000 during the week. Another example, it's possible to buy a call option, for example, for a stock XYZ, chemicals, by 20th of June at $60. This gives you the right, in other words, you don't have to exercise it, but not the obligation to buy the stock. If the price is now $58, and let's say the option costs you $4, if the price does not change between now and 20th of June, you simply wouldn't exercise the option. It wouldn't be worth it. Otherwise, you're paying $62 for the stock, and you effectively lost the $4 that you actually paid for the option premium. But if the price goes up to $70 in March, and even before getting to March, you've gained $6 because the price of the option would go up. It has hit the strike price, and all the prices above that are considered to be in the money. Should you exercise your option now? What if the price goes up any further? What if it stays the same? What if it goes down? In other words, what is the value of an option? Another question, how do you price options? Well, a premium is the intrinsic value, in other words, the difference between the strike price of the asset for a call option and the actual price, and the time value. What's the value of actually waiting for those extra months? And on that time value, there's obviously a discount value, which is obviously based upon the present value of waiting for 3 months. But there's also the quest that the price can go up or down. Options almost always trade above the intrinsic value. The time value is the value which can go up or down, and that is effectively due to uncertainty. An attempt at valuing options was made by what's called the Black-Scholes model. Tried to model that, which we'll look at next. You can actually get mathematical formula to work out the Black-Scholes. The Black-Scholes model is based upon the call price, the current stock price, the time until expiration, the strike price, the risk-free rate of interest, the cumulative standard normal distribution. So the implicit assumption is that the share prices above or below the strike, the price you agree, are normally distributed, which of course may not be true. And S is the standard deviation of stock returns, and ln is the natural logarithm. Now, the Black-Scholes model has been quite useful, but it can go dramatically wrong when you have events which don't fit within the normal distribution. So what's the determinants of the option premium? The more volatile the asset price is, this will increase the option premium, according to the Black-Scholes model. The closer you are to expiration date, the option premium will approach its intrinsic value. The further you are away from expiration, the higher is the option premium. And obviously a higher interest rate reduces the option premium because it impacts on the present value. What are the benefits of derivative markets? Derivative markets are literally enormous. Derivative markets provide risk-sharing potential, they provide liquidity, and they provide information. Derivative instruments tend to be liquid and tradable because they're standardized, and anonymous trading reduces information costs. There are other forms of derivatives. There's credit derivatives. Credit derivatives are financial contract that transfers the credit risk of a reference asset, also known as a name, from one counterparty to another in exchange for payment. An example will be a credit default swap, which we'll look at later in this lecture. You can insure, say, General Motors bond by buying a credit default swap agreement with, say, AIG, American Insurance Group, and you pay a premium to this if General Motors defaults and doesn't pay you. In this case, if they default, AIG will pay the default, the money that you would expect, but you pay a premium like an insurance to do that. So derivative markets add value. Savers, borrowers, funds, returns, information, liquidity, risk sharing possibilities. And this is just graph just shows you some of the value which is added through derivative markets. We will look now at another financial instrument or range of financial instruments called mortgage-backed securities. First, we have to understand a little bit about securitization. Then we look at mortgage securities, mortgage-backed securities, different types of mortgage-backed securities, and the risks involved. Well, securitization, what is it? It's the process of aggregating similar instruments, could be student loans, mortgages, other forms of debt instruments, into a negotiable security. So debts which are not traded into debts which are actually traded. So you have creditors, a financial institution, putting together the debts into a private company or agency, who then look at action to improve the creditability, the credit worthiness of the asset, make it liquid, and then sell it to investors. What is a mortgage loan? It's a contract between two parties, a borrower and a lender. What is a mortgage security? So a mortgage-backed security is a security that's based on a pool of underlying mortgages. So you have the bank, which is the originator of the mortgage, lending money to people who are buying houses. This is pooled, put through an agency or private corporation, and then sold to investors who could be corporations, life insurance companies, pension funds, or other banks. Who are the players in the United States mortgage-backed security? Ginnie Mae, which is the Government National Mortgage Association, Fannie Mae, which is the Federal National Mortgage Association, and the Federal Home Loan Mortgage Corporation. It's a security. There are several different types of mortgage-backed securities. Two main types are collateralized mortgage obligations and stripped mortgage. Well, let's look first at the different types of collateral mortgage obligations, of which there are several, and they are listed here. Basically, they're bonds that represent claims to specific cash flows from large pools of home mortgages. A stripped mortgage-backed security is the cash flows from the underlying mortgage loans are divided to create two or more new securities. Principal-only securities and interest-only securities. What are the risks of buying a mortgage-backed security? Well, the risks are prepayment risk, the fact that people pay off their mortgage loans a bit earlier, risks regarding the average life, and market risks. Prepayment risk occurs when the house owner is selling the house or refinancing the mortgage. The investor in a mortgage-backed security is assumed the risk that the mortgage-backed security will pay principal faster or slower than expected. Average life, when talking about the maturity date of mortgage securities, we're talking about the average life of the security. The average life, unlike a bond, which is fairly certain, is the average time that each principal dollar in the pool is expected to be outstanding, based upon certain assumptions about prepayment speeds. The market risk is the risk that the price of the security may fluctuate over time. Generally, in mortgage-backed securities, like most asset-backed securities, the security is created from a portfolio of loans, bonds, credit card receivables, student loans, mortgages, auto, car loans, aircraft leases, music royalties, etc. But usually the income from the assets is tranched. So there's a waterfall effect which defines how income is first used to pay the promised return to the senior tranche, then to the next more senior tranche, and so on. So let's look at a possible security. You've got a mortgage-backed security with N assets. The principal is 100 million. These are all put into a special purpose vehicle. The first tranche, called the equity tranche, has a principal of 5 million, yield of 30%. Second tranche, which you might call mezzanine, principal is 20 million, yield is 10%. Then the more secure part, called tranche 3, is the super senior. Principal is 75 million, but the yield is obviously lower at 6%. The mezzanine tranche is the most difficult to sell, but it can be repackaged with other similar mezzanine tranches. So the super senior tranche, for example, at AAA, the mezzanine tranche at BBB, the equity tranche, which has a very, very good return, is generally not rated, but it's a very, very small part. In the financial crisis, mortgage-backed securities were heavily involved in the problem. Between 2000 and 2006, mortgage lenders in the US relaxed standards. This was partly because of government policy and partly because interest rates and returns were fairly low. The demand for mortgages, called subprime mortgages, increased quickly, and there was a move towards securitizing mortgages using asset-backed security and what are called asset-backed security CDOs, or collateral debt obligations. Finally, in 2007, the bubble burst. House prices started decreasing, increasing defaults, and foreclosure mortgage loans. Let's now look at credit derivatives, often called, like CDOs by Warren Buffett, financial weapons of mass destruction. Credit default swaps are a very, very big market now, with over 40 trillion of notional principal value. The buyer of a credit default swap as a financial instrument acquires protection from the seller against default by a particular company or a country, which is called a reference entity. For example, a buyer may pay a premium of 90 basis points per year for $100 million of a 5-year protection against a company X defaulting. The premium is known as the credit default spread, and it's paid for the life of the contract or until a default occurs. If there is a default, the buyer has the right to sell bonds with a face value of 100 million, even despite default, issued by company X for 100 million. Several bonds are typically deliverable, but it's the seller which has the problem. Here's a typical credit default swap structure. The recovery rate R is the ratio of the value of the bond issued by a reference entity immediately after the default to the face value of the bond. Buyer A is getting default protection and paying 90 basis points per year to the default protection seller, which is B, and receives a payoff if there's a default by the reference entity equal to 100 divided by 1 minus R, multiplied by 1 minus R. Now the point is, the actual buyer of the default protection doesn't necessarily have to even own the bonds which may default.